Hi, Jeff, Peter. Thanks for joining me.
Thanks for having us.
Yeah, it's good to see you again, Steve.
Good to see you both. Talking today about multifamily, that there's some problems in multifamily for some risky investment models we've seen pop up recently. We're seeing apartment loans that are generally fixed rate long-term mortgages, but during the pandemic, we saw some investors take out more shorter term floating rate loans, oftentimes borrowing more than 80% of the value of the building. These folks did not anticipate that interest rates could rise so quickly, or nor did they anticipate insurance premiums going up and rent growth slowing. And a lot of these firms are now running into some real serious problems. Just want to kind of tap your guys' expertise and thoughts on what we're seeing here. That's a particularly a negative development for a portion of multifam investors.
All right.
Peter, go ahead.
Yeah. Well, two things. They're not just running into trouble; they are actually liquidating their positions because they did just what you're talking about. They decided that the values were too good to be true, and so they refinanced, and they played roulette with interest rates and got squeezed. So, that's actually not an indication that multifam is in trouble. That is an indication that some of the sponsors made a huge bet that didn't pay off. That's what's happening.
And to back
Yeah,
up there,
What do you think?
I'd second it. I actually was going to say, I still go back to the model where you're going to some of these multifamily conferences and trying to figure out what people were doing, buying at 3 caps, then trying to tell me that they're going to sell it down the line for a 4 or 5 cap it after they've increased income, only to find out that their ancillary income is what they're increasing. It's a bad model. If you can't fundamentally, or I guess let me take a step back. If you can't actually, improve on the fundamentals, ancillary income definitely doesn't support you at 80% leverage.
yeah, and I wanted to kind of just throw out a few points here to really support what you're both saying, that we've seen in Los Angeles, Houston, and San Francisco defaults against thousands of apartments from some of these multifamily owners that use these kind of risky models. And then in particular, I think it's a Veritas Investments, one of San Francisco's largest landlords. They've defaulted on debt backing over 95 different rental buildings just in the past year. And looking to lose more than a third of their San Francisco portfolio. So, some of the numbers, and I think some of the exposure, maybe some of the regional banks too, it's meaningful. But as you guys are pointing out, this isn't the entire sector. This is some fairly risky models that a minority of operators really chose to pursue.
Yeah, and also locations. San Francisco is a world unto its own, just like Detroit was, and maybe like Los Angeles is today. So I think it's difficult to lump all of this together without some definition of what's going on.
Yeah, good
Where?
points. So, not only are we just talking about a subset of investors that used variable debt, used a lot of leverage, really used some pretty risky models. We're also, to a degree, talking about some particular metros that have been hit harder than others. I'm going to opine that I think the lessons to investors here is, pay attention to how folks are making their money. If they're doing it with variable debt, if they're doing it with a lot of leverage, these basic things really do matter. You guys' closing thoughts?
Well, this kind of just reminds me of Joseph Kennedy from, I think it was like 1929, said when my shoe shiner was telling me his favorite stock picks that he knew it was time to get out of the market. I think 12, 18 months ago when people were telling me that their favorite picks were multifamily and it was based off of you just don't get it because we can increase ancillary income, I knew that was a bad time.
Well, like you said, Jeff, my favorite pick, by the way, it's a 3 cap, but it's still my favorite pick.
Yeah.
All right, Steve, I think we've said it all.
Appreciate the insights, guys. Thank you.